Hello and good day to all my students. So this is the continuation of week 9 under the topic risk and return. So these are the topic outlines that we're going to cover for this lecture session. We're going to start off first with the discussion about the returns, and then we're going to discuss about risks, and then we're going to look into the portfolio, where we're going to know how to calculate the return of a portfolio as a whole. So what is return? Return is the reward we receive for investing. The reward can either be periodical return, or the one-off capital gain where we sell off the investment. So there are two ways for us to measure returns. One is by calculating the absolute value of the return, and the other is to calculate the percentage of return in relative to the amount that we have invested. Okay, so for example, Abu has purchased 100 unit shares of Jaya stock at 10 ringgit per share. So he held the share for 1 year, during which time he received dividend of 80 cents per share. So the dividends here is the periodical return, meaning that if Abu maintained its ownership on that shares for years to come, he's going to receive an annual dividend of how many cents per share is it, depending on the board of directors discussions, but he's still going to receive an annual types of return here. However, at the end of 1 year, he sold the shares when they were 45 ringgit per share. So when he sell off the shares, so this is what we call as capital gain, where we sell more than what we purchase. But if we are selling less than what we are purchased, then we call that as a capital loss. So the question is asking, what is the holding period return? So our return here consists of periodical return and capital gain. So the periodical return refers to the dividend, and the capital gain is referring to the profit that Abdul received when he sell off the share. So 80 cents times 100 units plus the capital gain, 35 ringgit per unit of capital gain times 100 units, divide by, see here, in relative to the amount that we have invested, divide by amount that we have invested. So Abu purchased 100 share at 10 ringgit per share. So this is the amount that we have invested. So Abu's return here is 358%, meaning that not only did he receive back his investment of 1,000 ringgit, on top of that, he also received an additional profit of 3,580 ringgit. That's what it meant by 358% of return. And return can also be measured in terms of absolute value here. So this is in terms of percentage. Return in the absolute value is 3,580 ringgit. So return can be classified into three types. The first one is the actual return that we have already received and it's historical in nature. And the next one is the required rate of return, which is the minimum return that an investor must receive to compensate the level of risk that they have taken. And the third one is the expected return, meaning that the estimated or the anticipated return in the future. So how do we measure required rate of return? So we're going to use the capital asset pricing model, where the risk premium of stocks of stock systematic risk is included, meaning that we assume that if a security has a certain level of risk, then the return that we calculated using the CAPM model must be comparable or must be must be compensated with the risk that they have already taken. So what is risk premium? Risk premium is the difference between the market return and the risk-free return. For example, Noki Berhad has a beta of 0.55. Okay, so later on we're going to see what is beta coefficient here. We're going to see what does it do. If the expected return is 12% and the risk-free rate is 4.5%, calculate the required return of Noki Berhad. So the formula using the CAPM model here is the risk-free plus beta times with the risk premium. And the risk premium is the difference between the market return and the risk-free return. So put in first the risk-free, which is 4.5%, plus with the beta of 0.55, times with the risk premium, the difference between the market return and the risk-free return. Okay, so you minus this first, times with the beta coefficient, plus with the risk-free rate. So the required rate of return is 8.625%. What does it mean is that the minimum return an investors of Noki Berhad would accept is 8.625%, and if Noki Berhad offer them return lower than 8.625%, then it is not comparable to the risk that they have taken. This is the risk that they have taken. Therefore, investor would reject investing in Noki Berhad's stocks. Okay, next is expected return. So expected return is measured by considering the various investment alternatives that may occur in the future. The percentage of probability outcomes for future are the weightage to calculate the expected return. So let's do some example. So Jaya is considering to invest in the project costing 60,000 ringgit. The firm's manager has forecasted the project's return as follows. So you are required to determine the expected cash flows. This is the return in form of absolute value, and also the expected rate of return from the project. So this is the return in form of percentage. So this is the forecasting that the company has done, in which they have anticipated three forms of economic situation, meaning that next year the economy might be in recession, or the economy might be in moderate situation, or the economy might face or might experience expansion or booming economy. And they have done their research, and these are the probability of outcomes that they have assigned to each of the state of economy, meaning that next year there is a 20% of chance the economy will be in recession. 30% of chance the economy will be moderate, and 50% of chance that the next year's economy might be in expansion. Okay, so these are the probability of outcomes. And then they give you the return if the economy is facing recession. The return is only for 7,200. But if next year's economy is in expansion, then the project might give you 12,000. Okay. So since the question wants you to have the cash flow in terms of absolute value and also the return in terms of percentage, so you need to convert this into the percentage form. So if you still recall, when we calculate the holding period return, the return is divided by the initial investment. So in this case, the initial investment is 60,000. So if the economy is in recession, the expected return would be 12%. Okay, but if the economy is in moderate, then the return might be 15%, whereas expansion it might be 20%. So we can calculate first the expected return or the expected cash flows. This is the formula that you should use. This is the sum of probability times return. Probability times return, probability times return, probability times return, and then you sum it all up like this. 0.2 times 7,200, 0.3 times 9,000, 0.5 times 12,000. So please do not use in percentage form, convert it into decimal point. The probability is the weightage, so the probability must always equals to 1. Must always equals to 1. So make it into 0.2, 0.3 and 0.5. Therefore, you should get the expected cash flows to be at 10,140. But if the question asks you to calculate the expected rate of return, see the word rate here, kadar, rate, then you need to use the return in terms of percentage, 0.2 times 12%, 0.3 times 15%, 0.5 times 20%. So you get 16.9%. Next, we're going to talk about risks. So what is risk? Risk is a chance that some unfavorable event will occur. It is a chance of a monetary loss. So if we are investing into something and we do not know the future, okay, we may experience loss or we may experience gain. The chances that we are getting loss is what we call as risks. Okay, if I know the future, if I know exactly what I'm going to get if I invest in stock A, is there any risk involved if I know the future? So there is no risk involved. Because we do not know the future, there's a chance that our investment might go badly. Then we call that as a risk. So risk is measured by calculating the variance and the standard deviation. So we're going to see how much our expectation. Remember that we've calculated earlier on the expected return 16.9%. How much is our expectation deviate from the actual result? How much our expectation deviate from the actual result? So the bigger the deviation is, the more difficult for us to forecast the future. Therefore, the risk is high. If I expect the stock to give me 10% return, and next year it gives me 10% return, so it means that I've already expected that to happen. So the risk is 0. Okay, if I expect next year to be 10%, but some unforeseen reasons, next year's return becomes 5% only. So now we have a deviation around 5%. Okay, then the stock is considered to be as risky. Okay, so let's look at how we calculate the standard deviation. So I'm continuing on from the previous questions where we have already calculated the expected return to be at 10,140 or 16.9%. So we need to calculate first the variance. So I can present my answer in form of ringgit or in form of percentage. So I'm going to show you first how we do it in terms of ringgit. The formula to calculate variance is the sum of probability times the difference between what we have received and what we have expected. Okay, return minus the expected return, and then don't forget to square the equations. Okay, if not, you're going to get your answer for standard deviation to be at 0. Okay, don't forget to square your answer. So I put in the probability here times the return for that economy of recession minus our expected to be at 10,140, and then I square it. Then I go to the moderate economy, put in the probability 30%, put in the return that we will get if we go for the moderate minus the expected return that we've calculated. And then you can see the variance is around 3,848,400 ringgit. So to make it meaningful, we square root the variance for us to get the standard deviation. So here the standard deviation is 1,961 ringgit and 73%. So our expectation has deviated from reality around these figures. Okay, around these figures. There's a 95% of chance that our expectation will deviate by from the actual by 1,961 ringgit. If you want to calculate in the form of percentage, the same formula here, only we take the return and the expected return in form of percentage. And then we should get a variance around 10.69. We square root the variance. The standard deviation is around 3.27%. So the lower the standard deviation, the less risky the security is. The higher standard deviation, the more risky the standard deviation is. Alright, now we're going to see how should we choose between two investment alternatives based on their risk and returns. So these are the three scenarios that might happen. Okay, Ali has two investments, which is investment A and investment B. And for the first scenario, investment A and investment B returns are the same. Only that investment B return is 8%, whereas A is 5% only. So if this is the case, if the return remains similar, then we choose the one with the lower risk. Therefore, we choose to invest in investment A. For scenario 2, we can see the risks are similar, only that stock B has higher return compared to A. So we choose B because of a high return. But for scenario C, we can see for stock A, we has lower risk compared to B, but also lower return. Okay, if we choose B, we get higher return, but we also have to bear with the higher risk. So how do we choose between these two investments? We calculate the coefficients of variation, where we find out what is the risk attached for each 1% of return that we receive. Okay, so in this case, we can see that for 1% of return, stock A gives us 0.5% of risk, whereas for 1% of return, stock B gives us a risk of 0.67%. So of course, we're going to choose stock A because we have lower risk per 1% of return. Alright, next is the classifications. So we have two types of risk. One is systematic risk, the other one is unsystematic risk. So systematic risks are those risks that cannot be reduced or cannot be diversified, meaning that it affects all stocks and all sorts of investments types. For example, purchasing power risk, interest rate risk, and this kind of risks are usually measured by beta coefficients. But for unsystematic risk, we can reduce this kind of risk by diversifying our portfolio, meaning that we do not put our money in one basket. Instead, we separate our investment into many types of investment to build one portfolio. So example of unsystematic risks are the business risk, liquidity risk. Okay. So now we're going to discuss about beta coefficients. So beta measures security volatility relative to an average security. So it measures the security return over time compared to that of the overall market. So we're going to be able to predict how much stock A would change if the market changes. For example, let's say the beta for stock A is 0.5. It means that if the market average increased by 10%, then stock A would increase half of the market movement, meaning that they will increase by 5%. Okay, but if the beta is 2, then we can see stock A is more volatile because the market only moved by 10%, but stock A moved or increased by 20%. So the bigger the beta, the more volatile the security is compared to the market return. So meaning that higher beta indicate higher risk. But what if we have negative beta here? So it's the magnitude remains the same. It's just the reaction goes to the opposite way of the market. For example, if the market return increased by 10%, then the security return will decrease by 5%. So it goes in the opposite directions of the market movement. So we have 3 types of risk attitude: risk averse, risk taker, and risk indifference. So risk averse are those investors who dislike risk. They would demand higher return to compensate high risk. So this is the usual attitude of an investor. But if the investor is a risk taker, they would prefer to take risk and they are willing to accept lower return for higher risk of investment. And there are also type of investors who are risk indifferent, in which they obtain same level of situation in either risk averse or risk taker situation. Alright, next we're going to talk about portfolio. So if an investor is holding a diversified range of investment, then he is said to hold a portfolio. So a well-diversified portfolio may be, but not necessarily, consists of investment in stocks, bonds, units in mutual funds, savings accounts, derivatives, investment in real estates, or you can also diversify your stock into different types of security industry, like you hold stock in the consumer product, and you also hold stock in real properties companies. Then we can diversify our investment. So let's look at example. So Encik Tua owns a portfolio that has invested 15,000 in stock A and 25,000 in stock B. So they ask you to calculate the portfolio return. So before we can calculate portfolio return, we need to calculate first what is the expected return for stock A and the expected return for stock B. So we go back to the previous or the earliest slide where I give you this formula to calculate the expected return for A and expected return for B. Okay, probability times with the return plus probability times with the return. Next, step 2, we need to calculate the weightage of investment that Encik Tua has put in stock A and stock B. So from here we can see Encik Tua has invested more in stock B as compared to stock A. So any loss or return again earned from stock B must reflect more in the portfolio return due to the higher weightage of investment. So we calculate weight A, invested in stock A is 37.5%, meaning that Encik Tua has invested 37.5% of his money in stock A and he's invested 62.5% of his money in stock B. Then we can calculate the expected return where it is the sum of the weightage times with the expected return that we've calculated previously. And then you get the return for the portfolio to be at 14.69%. Okay, diversification means spreading an investment over a range of investment instruments so that risks of losing all the investment can be reduced. The reason why holding a diversified portfolio can reduce risk is because value of these different investments will not decrease or increase in same magnitude. For example, if the value of stock decreased, then the value of stock may increase, and therefore it would set off any loss an investor has incurred from the stock using the gain that we received from the bond. Okay, however, diversification cannot eliminate all risks because of the existence of systematic risks, like purchasing power risk, inflation risk, interest rate risk, because those type of risks affect the company as a whole and will affect all types of investment. So we cannot run away from systematic risk, but we can reduce the unsystematic risk. So these are the effects that we can see. Let's say I have two stocks in my portfolio, and the stock are positively correlated, meaning that if the stock A increase, stock B will increase as well. If the stock A decrease, then the stock B will decrease as well. So any gain or any loss received will be double. Okay, will be double. Or you can go also to the zero correlated diversification. For example, like you invest in stock A where it fluctuates, and then you invest in the fixed deposit investment where the return remain constant over the year. So you can see there's a bit of diversification happening here, especially when stock A is going down. At least we have return from stock B to offset the loss in stock A. Okay, but the best investment portfolio to have are those with negatively correlated diversification, where any loss in A will be offset by the gain in B. Any gain in B will be offset. Any loss in A will be offset by the gain in B. Okay. So that's the end of the previous lecture. Now we're going to see how questions are asked in final examination. So let's do some tutorial. Okay, so we're going to use past year question as a guide for us to do tutorial in chapter 7, risk and return. So I take the example from June 2019, question number 4. Syarikat Aman Sdn Bhd wants to select the less risk of two alternative assets. The asset possible returns and related probability for each economic outcome are as follows. So they have given you 3 probability of outcomes. Yeah, so it means that in the future, the economy might be in an optimistic condition, or in the future it may resume as normal, or in the future we have a pessimistic outcome of the economy. And these are the probability of outcome that the chances that it may happen. Okay, for example, there are 20% chance that the economy might be optimistic. There are 50% chance that the economy may resume as normal. And there is a 30% chance that the economy might be in the pessimistic conditions. And if the economy is in the optimistic condition, these are the return for asset A and asset B. These are the return for the normal economic outcome for asset A and asset B, and these are the return for the pessimistic economic condition for asset A and asset B. So the question gives you the requirement. They ask you to state the amount of expected return for both assets, and then they ask you to identify the standard deviation for both assets, and then they ask you to choose, to explain which asset should be chosen by the company. Okay, so how do you go about tackling this kind of question? So you need to know the formula to calculate the expected return. So this is the formula to calculate the expected return, where it is the sum of probability times return. Okay, so when you want to calculate the expected return, please remember that probability is a weightage amount, weightage amount, meaning that it must equal to 1. It must equal to 1, meaning that 0.2 plus 0.5 plus 0.3 must equal to 1. So if the question doesn't give you 0.2, but instead they give you 20% of chance, 50% of chance, and 30% of chance, do not, I repeat, do not put 20 times 35. It will be wrong because probability is a weightage. Instead, you must use in the decimal point, meaning that 0.2 times 35, 0.5 times 25, 0.3 times negative 10. Okay, please remember probability is a weightage amount, so it must equals to 1. Okay, so you times accordingly, use your scientific calculator, you just key in all the figures in one go, you should get your answer to be at 16.5%. Okay, and when you want to calculate standard deviation for asset A, the formula is as follows. Okay, it is the square root of the sum of probability times with the deviation here, the return minus the expected return, and then don't forget to square. Do not forget to square. If you forget to square, meaning that you write as 0.20 times 35 minus 16.5, and then you forget to square the answer, your answer will become 0 here. You will not get any figure. Your answer will become 0. So there's no such thing as 0 risk for a normal investment. There must be some sort of risk. So if you get your answer to be at 0, it means that you forgot to square your figure. Okay, it means you forgot to square your figure. So please remember to square this. Yeah, oftentimes I found students to forget to square, to put a square in your calculation, and then they say that there is no risk attached to asset A, which is wrong. Please remember to square your standard deviations. And then you get 315.25. This is what we call as variance. Yeah, this is variance. So variance, you need to square root, you should get standard deviation. Okay, standard deviation. Because some question in your past year, they don't ask you to calculate standard deviation. Instead, they ask you to calculate first the variance. Yeah, first they ask you to calculate expected return, then they ask you to calculate variance, then they ask you to calculate standard deviation. So you must show me the value of variance if the question asks for variance. Okay, and then when you want to decide whether to choose asset A or asset B, you need to calculate the coefficients of variations. So coefficient of variation is the measurement of risk per 1% of return. The measurement of risk per 1% of return, meaning that for each 1% of return, how many percent of risk do I need to bear? So that's why it must be standard deviation divided by expected return. Do not put it upside down. It must be level of risk as the measurement of risk per expected return. So 70.76%, the one that you've calculated previously, divided by standard deviation, divided by expected return, the one that you've calculated previously, and you should get to be at 1.0761, meaning that for every 1% of return I get, I will have to bear risk of 1.0761% of risk. Okay, so in this case, you can clearly see that asset B has higher risk compared to asset A. So which one should I choose? It depends on the question. It depends on the question. If the question says that the company is a risk taker, then you choose the one with the higher coefficients of variation. If the question says the company is a risk averse, or if the question doesn't say anything at all, please assume to be at risk averse. Okay, so in June 2019, it clearly says that Syarikat Aman wants to select the less risks of two alternatives. It means that Syarikat Aman is a risk-averse person. So you choose the one with the lower risk. So the answer should be the company should choose SLA due to lower coefficients of variations. Okay. The next step of question is on June 2018. Okay. In this case, they ask you to calculate the holding period returned. Yeah. Or in other words, returned. So Azizi purchased one lot of Hazi Berhad's shares for 10 ringgit per share. He received dividend of 50 cents per share. At the end of 1 year, he sold it for 8 ringgit per share. So in your textbook or in the video presented by Dr. Noriha, how do we calculate holding period return? Is the current income plus with the capital gain divided by our initial investment. So our income is dividend of 50 cents per share. So one lot is always at 100 units. Okay, please remember that. So meaning that 50 cents times with the 100 units. So Azizi received dividend of 50 ringgit for 1 year. Okay, but he sold it after the end of 1 year for 8 ringgit. Okay, which means he's making loss because previously he purchased the share at 10 ringgit per share. So he makes a capital loss of 2 ringgit per share. So times with the 100, so you have a capital loss of 200 ringgit. Okay, 200 ringgit. So and then you divide by the initial investment, which is at 10 ringgit. We're going to see it after this. Okay, Ikrimah Sdn Bhd handles construction project. At present, the firm has potential project to be evaluated as follow. So they have 4 projects to consider, and under project 1, there are 2 jobs to be chosen. Okay, they want to choose either PQ or QR for project 1, or they want to, and then for project 2, they want to choose either ST or TU. So the question says that identify with a reason the job of the project that the firm is supposed to choose. Okay, meaning that they're asking whether project PQ or QR that the company should choose under project 1. Okay, so you can clearly see under project 1 the expected return for both projects are similar. So you choose the one with the lower risk, so you choose QR. Project 2 also, they have a similar level of risk, so you choose the one with the higher return, which means you choose project ST. But for project 3 and project 4, you can see that the risks are different and also the return are different. Therefore, you need to calculate coefficients of variation later on. Okay. So this is for the previous question, the Azizi's one. Okay. You are making a loss here, meaning that you have gain here, dividend income, but you have to offset with the loss of the capital loss from selling of the stock. So divide by the initial investment, which is the initial price that you purchase for one lot. So you make a negative 15%. Okay, it must either you present your answer to be a negative 15% or you say 15% loss. I accept both answers. Okay, for project 3 just now, we need to calculate the coefficients of variation. So standard deviation divided by expected return. You get 0.34. Compare it with the WX, which is only 0.18. So you choose WX due to lower risk. The same goes for project 4. You calculate the coefficients of variation for YZ, which you get 0.21. Compare with the ZA 0.20. So you choose the one with the lower coefficients of variation due to lower risk. Simple. Okay, another type of question is on January 2018, in which they ask you to calculate the portfolio returned. Okay, so Taufik owns a portfolio consists of 45% of stock A, 30% of stock B, and 25% of stock C. What it means here is that, let's say that Taufik has 1,000 ringgit. Okay, and for the money that he has, he spent 40% of the money to stock A, and then he spent 30% of his money in stock B, and then he spent 25% of the money in stock C. So this is the weightage. This is the weightage. So if you still remember, weightage must equals to 1, not 100. Yeah? Must equal to 1. So when you want to calculate weightage, please use 0.45, 0.30 and 0.25. So it must equals back to 1. Please do not use 45, 30 and 25. You will get your answer to be at thousands, which is wrong. Okay? And if for stock A, it had the expected return of 20%. For stock B, it has return of 12%. And for stock C, it had return of 9%. So you times with the expected return accordingly. So the portfolio return, the weightage of portfolio return is 14.85%. Okay. So for part C, Terrible Asia has a beta of 0.45 given that the expected market return is 10% and the risk-free rate is 4%. Calculate the required rate of return of Travel Asia. So they're asking you to calculate the required rate of return. The formula is in your textbook, yeah, which is the risk-free rate plus with the beta times with the risk premium. We call it as risk premium. Okay. So, but the question doesn't give you risk premium, but you can calculate on your own. Yeah? Market return minus the risk-free return. Okay, so you just put in the figure accordingly. You should get your required rate of return to be at 6.7%. Okay, next is on October 2016. Pasir Emas is a risk-taker firm. See here, the risk-taker firm. There are two projects which are currently be considered. Number 1 is Project Rezeki 1 and number 2 is Project Rezeki 2. Okay, so they ask you to calculate the expected return, identify standard deviation, and then analyze which project should be chosen. Okay, so but in this case, they don't give you the return in terms of percentage. Instead, they give you return in terms of ringgit. So no problem. No problem. It means that your expected return will be in ringgit, your standard deviation will be in ringgit, and so no problem. Okay, so we calculate as usual the formula, the sum of probability times return. So you put in the return in terms of ringgit, and then you get your expected return to be at 183 250. The same goes for Project Rezeki 2, 199 500. Okay. So when you want to calculate expected standard deviation, okay, please do not confuse with the 0. Okay, I know you tend to calculate as in like 100 minus 183.25, yeah, or you want to leave it at 100. Okay, so please be careful when you key in the figure in your calculator. On the safe side, you just type all of the zeros, and you shall get your answer to be at 9 million here. 9 million. This is your variance, yeah. This is your variance, and when you square root, you get the standard deviation to be at 99,086 ringgit and 77 cents. Okay, so you calculate the coefficients of variation for Project Rezeki 1, 0.45, and Project Rezeki 2 to be at 0.26%. So which one should you choose? Please choose one with the higher coefficients of variation, which means because just now Pasir Emas is a risk taker, right? So you choose the one with the higher coefficients of variation, which is Project Rezeki 1. Simple, easy. Okay, so you're going to see in your past year later on that most of the questions on risk and return are similar. They ask you to calculate the expected return, or they ask you to calculate standard deviation, and then they ask you to choose which project should be chosen. If they want to ask extra question, they might ask you on the portfolio return, or on the required rate of return, or ask you to calculate the holding period return, the one that we've calculated previous on. Okay, so that's the end of the tutorial for risk and return. Again, any question you can ask me, you can WhatsApp me. I would prefer if you WhatsApp through group WhatsApp so that everybody can benefit from your answers.
And thus I end my presentation. Wabillahi taufiq wa hidayah. Wassalamualaikum warahmatullahi wabarakatuh.